In Hawaii there's so much to do. There's hula, there's surfing and real estate too. We just two local guys with so much to say. So listen to the Real Estate Braddahs today.
Hey, so we are live here. This is episode 30, August 2020, monthly market update. This is the Real Estate Braddahs. Topics today, Oahu statistics on real estate and economist point of view. We're going to talk about the Coal Ridge. And then when the heck is that going to start? But starting off, a little bit of a free giveaway. The 2020 version of the buy and hold analyzer for rentals. You can get it in Excel or Google Sheet, however you want to use it. Full explanation of all expenses for you to make your own performance and spot check performance given to you. Performance sensitivity analysis. You guys can get it by shoot me an email, Lane at SimplePassiveCashflow with buy and hold analyzer in the subject line, and I'll send it out to you guys. And Dean, why don't you take us away?
Hey everyone, thanks for joining us. Lane, I think we're on episode 30 for our monthly Braddahs real estate show. How we changed over the years, over the episodes, Lane, from the first episode to this one. It's kind of interesting how we're pivoting, but that's always so awesome. But anyway, so jumping right in, talking about Oahu market. So the statistics for July, Oahu just came out today, so this is hot off the presses. But kind of interesting. So you see the red arrows going down, and again, this is July 2020 compared to prior year 2019. So we see overall that there's a slight dip in terms of median prices. So median single family homes went down to 815,000, 2.4% reduction. Closed sales also went down a little bit at 361, a 3% reduction. But take a look at these median days on market for single family. It went down 24% almost, 4 days quicker at 13 days. That's really quick. And we'll talk a little bit more about that. So similarly on the condo, median prices went down from to 440,000, almost a 5% reduction. Closed sales also went down 17%, 426 closed sales, and no change in the median days on market, which, I mean, they're both still, they're under a month. And we saw them creeping up last month, especially for the condos. I think it went to 40 days, which is still not that bad, but now we see it going back down. So it's kind of interesting how we're seeing how things are affecting. So the story goes is compared to prior year, things have slowed down a bit, but when you're comparing it to our current situation compared to April, May, June, it is increasing when you can talk about month over month sales and activity. So on the next slide, we just talks about a little bit of how it did change. So single family, we see an increase of, it's blocked for me, was that almost 20%, yeah, compared to June. And for condos, we see almost a 37% increase in sales compared to prior months. So we're seeing activity picking back up, which is exciting. Again, month to month we're picking up, but year over year where it's a slight setback. So the next few slides I'm going to show kind of like the trend, right? So we're talking about like how we just talked about closed sales, and so we see the kind of bottomed out in May, and we see it starting to ramp up these last 2 months, which are a good sign. I think next slide we have, I'm talking about is that median sales prices. So if you see, again, it's kind of coming back up. The yellow line on the bottom is the condos and townhouses, and so 2-month upswing, and then the green above is the town houses. But as you can see, I mean, it's if you're like a technical analyst, we're still in this. There's this belt and this range. These two ranges are staying pretty stable. So that's kind of a good sign amongst all the things going on with us economically.
The way I read it, I see prices going down, right? Because this stuff should follow inflation, which is like 2%, 3%.
Yeah, so you're talking about inflation too, right there. I guess the theory is that there's the short term, it's a short term deflationary period is what they're saying, but the long term would be inflationary. But I guess that's for another discussion. So yeah, like you said, compared to prior years, doesn't look as good, but just compared to our bottom, in April, May, it looks a little bit better. So then you had the days on market, and this is where we see another downtick. And again, days on market is a point that an inventory a unit is listed and until the point that it goes into escrow. So we have it going back down again for the month of July. So that's I guess you could say a little bit positive light on the real estate market compared to the rest of our economy in the state and in the nation.
And what this is like essentially it's a days. How much if you put out a house on the market and you price it pretty decently, they're saying it should sell in this many days.
Right.
Of course, this is average. You got I'd say a minority of people who kind of price it like a bonehead and too high. Maybe they're not motivated to sell it. And obviously those are going to go 90, 180 days. You see some of those properties out there for a super long time. So I would say most times, under a couple of weeks, right? You got what are your last listings?
If you price it right, you're hoping to, and when I say price it right, that's for a whole nother discussion, but pricing it right and in the market, you're hoping to have that first open house with multiple offers. So then you can go back and use that as leverage, because whenever you're in a multiple offer situation, you can then let all the buyers know that we have more than one person interested, so bring us your highest and best offer. So that's always exciting when you have a multiple offer situation and gives the sellers a lot of leverage. So
what is your kind of general strategy? I'm not a residential agent, but when I work with when I try to sell my rental properties off, I was trying to figure out, all right, let's figure out what the market price is, and let's call that 100%. Let's list it for like 95 to 100%.
Exactly. No, that's exactly it. You want to be
lure in a couple offers, right? Is that
exactly? That's my strategy too, from the standpoint of you want to be at what you think you're going to get offered or slightly below, because you want to be in that multiple offer situation, because there's so much leverage you get versus if you just have one buyer and their offer in hand. That's exactly it. And the challenge is too, in like our current market, is when you've had the last 5 years of the market going up, you can, on an upward market, if you price it above the market price, theoretically it'll catch up and you'll catch it on the upswing. But when you're plateauing or on a down slope, it's very challenging when you're pricing. So working with sellers who are reasonable, understand this is very important, and that's part of what I try to do, is try to communicate to the sellers. Like, it's very important, and of course, again, we're in this COVID and it's a very new environment. So in the next couple of slides, we can talk about too how things are changing in terms of the condo versus single family too. Yeah. So you're already kind of seeing the difference in terms of median days on market. And so now when you talk about new listings coming onto market, we see that for the yellow line, which are the condo townhouses, we see it going up, up, up. Similar for the single family. But why this is important is because this is what feeds into our months remaining of inventory, which is on the next slide. If you go into that slide, Lane, months of inventory is basically if there were no new inventory to come onto the market today, how long it would take for the existing inventory to sell off. So you see the yellow line above on the condos, and we're at 4.1 for July, and it's kind of the same as prior month, right? But single family, it's actually going down. So single families are actually kind of more, I guess, the harder commodity right now. You see about a year ago that those two lines are kind of start bifurcating and separating out, and a lot of that was because of the short-term rental laws that came into be, and Airbnb and all that good stuff that we've talked about before. So with that said, a lot of the condo inventory that was doing short-term rentals, I think what happened was they kind of came into the resale market. So that's why we see a little bit of a starting of a bifurcation there, right? And then that's kind of what's adding to the little bit of weakness towards the condos in general, and we see a little bit of a split. Yeah.
I like that new word, bifurcation, divergent.
Yeah,
I mean, something's going
divergent.
on right here.
Yeah,
I mean,
exactly.
you think that is, I mean, especially come March, I mean, it shot up, what is that, 20%? I don't know. No, 10%, but that's significant. I mean, is
Yeah,
that
so
the short-term rentals, people's getting killed doing that stuff?
I think that's a part of it. That's definitely a part of it. Yeah, because of the fact that they can no longer cash flow, and it's no longer a viable business model for some people who bought and mortgaged out these properties, banking on the short-term rentals, because the margins, as we know, are a lot higher than for the buy and hold long-term rentals. Yeah, it's a lot more rent for these short-term rentals.
Yeah, the margins were slim to begin with, especially now that everything's shut down.
It totally depends on how you ran it too, right? Because there's some people who put in their own sweat equity and did their own turnovers or found some kind of cheap labor to do it. Or I mean, it's like anything, if you have some kind of competitive advantages, that's what made you able to do these kind of things, right? Once that whole law changed, that affected many short-term rental businesses. So next we have realtor.com schedule, and this is for Q1 of 2020. I'm waiting for the Q2 information to come out, but it's kind of interesting to show where the hot neighborhoods are, right? So it's kind of like a thermometer. So it's saying that out Eva Beach Pro City out on the west side is really hot, but then now we look at a lot of Honolulu's over there. Zip codes are coming in as kind of colder, and that's kind of consistent what we're seeing in the condos too, right? Because there are more condos and townhouses per se compared to out in Eva Beach and Pro City. So, and again, this is pre-COVID or just at the beginning of COVID, but we got kind of also talked about that too, right, Lane? Where it's like, now with the current situation, are people going to be moving out towards the fringe or the burbs because work isn't going to be calling them in as much? They can work remotely more. That option is becoming more available, and so that traffic issue isn't so much of a deal, because of a beach traffic coming to downtown is kind of crazy. So but
To me, when everybody's going one way, you want to be the opposite. You want to try and be buying maybe a smaller place downtown when they're vacating it.
right,
Think
I
when
mean, and
they
that's why
say,
we see that little bit loosening up or the softening up of the condo market possibly, right? And to your point, you want to zig when everyone else is zagging, right?
yeah, I think all the wine and all the other stuff that's statistically insignificant.
Yeah,
It's just
that's exactly. Yeah, that's a little slightly different.
it's
So
fine there.
So we're gonna jump around a little bit here. So yesterday we had the Star Advertiser put a video out about economist Paul Brubaker, and for me, I really like Mr. Brubaker. I like when he talks, so I try to listen whenever he talks. I had a college buddy who was a econ major when I was in the College of Business, so we'd rag each other, but he would he would rag me about being a finance guy, and I wouldn't really rag him about being econ, but he would drag me out to these presentations and these seminars and these conferences put on by DBED or HTA or whoever. And so Mr. Brubaker would always be there. Mr. Leroy Laney would always be there. So it's always good to hear them. And I enjoy what he has to say. On the next slide, I put some of the takeaways that Mr. Brubaker had to say. One slide that he talked about was comparing different industries and spending based on credit card sales, with the baseline being January 2020, and to see, looking at groceries and foods versus food service and arts, entertainment, and recreation. So in this scenario, we see that, of course, groceries and food stores jumped up just before the stay-at-home mandate happened, and then it kind of started, to level off, but it's still at above what it was in January. On the other hand, we have food service that plummeted, right? Because we were forced to stay home, and then started to loosen up. People started to loosen up too, and we see it kind of slowly coming back, but not to the baseline in January. Then we see arts, entertainment, recreation, and that plummeted even more. Again, making a slow comeback, but not nearly as much as food service. What he had to say about that too was taking a look at this is the small businesses are the ones that need to think about this. Look, take this chart to heart, and you got to pivot. And if you want to survive, you're gonna have to make adjustments, right? So a few of his quotes. So one quote I put is, whenever there's a large exogenous shot in the economy, there's always a possibility that things you think were only temporary changes turn out to be permanent. Yeah, so basically, he's talking to the businesses and saying that, again, I'll just read off his quote. If you're in business, or if you're thinking about changes in the employment landscape in the near future, I'd be thinking about how the structure of economic behavior changes among consumers and households, and how business can anticipate and respond and get ahead of and be leaders moving us in those directions. So I mean, it's been said before, and there's small businesses locally that are going down. And I wrote this too, right? I wrote this morning, and I know the news came out this afternoon that we're going through the second wave of closures. But yeah, the small businesses that survived this first closure, I mean, hopefully they can survive the second. And point is that if you are surviving so far, how are you going to make that shift, right? One quote that Mr. B said that I thought was kind of funny was, he said, "Don't tolerate a few bad actors that can't keep it in their pants." So for that, I mean, he's referring to the whole thing with, wearing masks, wearing PPE, and social distancing properly, because we know the cases are spiking. And he also mentioned that the answer to the economic problem is the answer to the ecological problem, right? We need to solve this issue before we can have people flying back in and getting our tourism up. He answered a whole bunch of other questions. Some people were asking about, the high prices of homes in Hawaii, and he said, housing is expensive in Hawaii because it's Hawaii. Another response he had to another question that I thought was kind of funny was, someone had asked about, us as a state trying to diversify our economy away from tourism. And his response was pretty cool. He just was like, you know what, if you want to do it, go knock yourself out. People have been trying to do this. We've had politicians who come on board running and say, this is their platform that they're running on, that they're going to change, get us out of this, diversify our economy, get out of tourism and military as our main sources of revenue. But it's not that easy. So the way things Mr. Brewbreaker responds is kind of funny. So I think sometimes either you love him or you hate him. But I enjoy his comments. So if you want a link to that, it's on the Star Advertiser website. But shoot me an email; I can easily send you the link. I thought it was very entertaining. I listened to it twice, and I probably listen to it again. It gives me kind of some sanity to a certain extent. Everyone does something different, so I like that. Again, his quote, "Don't tolerate a few bad actors that can't keep their pants on." I think today we had 2 deaths, which are very sad, of course. And this quote from the newspaper just tells us how, I guess, not to say out of hand, but it's not just these clusters anymore, right? So it says, close contact to the individual attended a spin class at a gym taught by a person linked to the Hawaiian Airlines cluster. So, I mean, it's no longer these small groups that they can track, right? So, and it's going quickly. So I guess my point to this one is, be careful and please, wear your masks and do social distancing. Maybe this doesn't have to be said now, being that we're going through a second shutdown. But again, when I was completing this, it was before Governor Ige and the mayor had come on. Jumping around again, I don't know, Lane, if you heard this, but there's been people that are getting issues with wearing masks now, and there's a term called maskne. So that's like acne getting caused by masks. And people are getting irritations and rosacea and all these issues. So now make sure that you have the proper size masks and you're doing things to control it. I thought it was kind of interesting. My other half had brought this up, and I said, let me just throw it in the slides, because I was like, yeah, more of these issues for us to consider. Now becoming the new normal. You know?
Something else, like when I was in the mainland last month, I had to check up some properties. Most people in the mainland, they wear the medical grade masks. They don't screw around with these homemade. I mean, the homemade stuff is cute, right? But supposedly they're not as effective, I guess. And they're sure as heck a lot less uncomfortable, in my opinion.
Yeah,
But
I bought a few on Etsy, and it ended up being thinner than like a cotton undershirt, and it really provided no protection. I had to okay, I'm not ordering any more of these. So moving on, Core Ridge. So last month was the first round of lotteries for Core Ridge, the master plan development over in in Central Oahu by Castle and Cooks.
what a bad time to come out with this thing, right?
Hey, you say that, but it was interesting because I was talking to the Castle and Cook representative, and I was asking her, so how did it go? So what happened was there were supposed to be 45 homes issued this first round and that were up for lottery. They only ended up doing 19 because the rest went to friends and family, but they ended up getting over 150 applications, which means the application included a pre-approval letter from their lender and also a notarized affidavit saying that they're going to live there for a year. I mean, starting prices for these single families are $885 for this first this Nanea, this first neighborhood, but it sounds like there's still demand, and they're priced at a price that people are willing to put in, right? But so what happened was, with this, there are a lot of people giving me calls and discussions being had, and we talked about the good and the bad. So I just wanted to talk about these points. So someone was saying, man, that's crazy. You're talking about 885 to 1.25 million or 1.025 million for some of the lots are like under less than 5,000 square feet, and it's starting at 1,300 square feet living. So I mean, what can you say, right? This is Hawaii, and that's what market price is.
How does it compare with like Kapolei, like that stuff? Is it bigger lots or better build or?
So when you talk about quality, that's a challenge. The lots are I think smaller. Again, you have different size lots in Eva, right? But I think they're typically a little bit bigger out in Eva, in general. Okay, of course, they're going to be older. So you're paying for this new build, and everything is, you're probably won't have to pay repairs and maintenance for 5 to 10 years. Versus if you're buying a resale property in Eva, where the roof might be a little aged, along with the different.
Not Eva, but like the Kapolei stuff. Was it DR Horton?
The new stuff.
Yeah, comparing because that's the latest new plan community, right?
Yeah, well, even there they have various different sizes, different size rates. So I think the thing that Core Ridge is going is it's closer to town, and then I mean you look at their previous master plan communities that Castle and Cook did, with Mililani Maka being the most recent, and I mean people love there, right? You got the new schools, really good public school system. You have the houses over there. I mean, they range similar to what Core Ridge is gonna do, townhouses and the whole nine. It'll probably, temperature wise, I'm thinking it'll be cooler than out further west, right? Because I mean, Mililani Town and Mauka is really cool. But anyway, another question was about the quality of the final product, and I think we talked about that too. Is like the developer is tried and true in terms of their previous builds, right? Another point that someone was talking about was, you're not going to have any neighbors, and you're not going to have any retail shops to go to for a while. And then there's also that red dirt issue, right? And that's a really big one. So, a counter to that argument would be, well, you have Waipio Costco so close. You have Walmart over in Mililani Town, shopping centers nearby in Waikele and Waipio Gentry. So, and when, the retail and commercial is developed finally in Core Ridge, I'm sure you're going to have some really good top-notch retailers moving in there, right? So if you're having the buyers paying almost 900,000 to a million for these places, you can imagine the demographics there, and so the retailers that would want to be in this neighborhood will probably be high end too, in theory. So, and the last comment is, how many people can say they're moved into a brand new house? That's very rare, and you're gonna be the one to break it in and all that. So, just some arguments and counter arguments to consider if you guys are thinking about looking into a new build or new construction like Core Ridge.
Let me know when you check out the open house and get the free hot dogs and hamburgers.
So here's I mean, they have
Oh, they have a date?
they have the end of this year is when the first construction is going to be built. I know if you drive by, you can see the structures going up, but they don't expect any. They're not going to have any model homes built until next year sometime. So you're literally buying off blueprints, and so maybe once this first round goes up, then you can see the first round that goes up, and maybe make friends with some of the new inhabitants and try to walk through. But yeah, it's not going to be till when I spoke to the rep last month, she was saying it's probably not going to be for another year, same time this year, next year, for the model homes to be in, which is pretty interesting in itself. But yeah, it is what it is, right? So yeah, in terms of popcorn, I mean, there's a sales office in YPO, and we can go check out. But I don't know if there's popcorn. It's pretty busy, I hear. So there is demand.
I think this just shows like the divide, right? Like people moving to Kapolei, smaller quarters, and then the high end stuff takes off. This is just the divide, the great divide, the haves and have-nots here.
Yeah.
I think you've been hearing a lot of like people can't afford to live here. If they don't have a job, they gotta leave. They can't stay here. Is what's happening. So
No, seriously.
Who's gonna buy this stuff? Yeah.
Yeah. I mean, it's crazy because it's like we already have a high cost of living, and we get paid less than our mainland counterparts. Most fields, I think so.
Yeah, I mean, when I moved back home a couple years ago, I had to take like a 30% pay cut for the same job. It's ridiculous. I don't know how people can survive out here.
It's crazy, man.
Mid-level engineer making 60 grand a year. That's ridiculous. Like,
right. Yeah, so we talked about this already. 45 homes and only 19-month lottery, 150 applications. The next phase of the first neighborhood is going to be coming out before month ends, but before then, there's probably going to be the lottery for the second subdivision called Luana, which are these duplex types places at 700,000 is the range that I've been told. So if you guys are interested, give me a ping and I can get you more information.
But it's got to be like some low income, right, or mid range is part of it.
Not these. I think these are still market, but again, they're like attached homes, right? So two or three attached to each other, and then hence the 700,000. So they're coming out. They're trying to figure out the pricing now. But I have to feel it's probably gonna be in the next couple of weeks and it's gonna be quick, right? Because this first round came out so quick, right? You had like 2 weeks to turn in your completed application, and then a few weeks before the lottery, and then 2 days after lottery, you had to go in and then you had to physically go in and pick which lot you wanted. So it's gonna be interesting. And again, there'll be a lot more phases and rounds of these lotteries as we say that's going to come up. So there will be time for if you're not ready now. Transitioning over to this topic. So I don't know about you, Lane, but investors are coming to me and saying, "Oh, where do you plan to put your money in?" They know I'm a real estate guy and I invest in real estate, but I also do stocks and bonds a little bit, and I know.
Oh, you're killing it, man.
Lane, I know Lane's gonna be cringing and shaking his head, but I am waiting for the next correction, and so I'm not a follower, or how do you say? I'm not a follower of Jim Cramer, but I do. listen to what his comments once in a while. And this was kind of interesting, where he's saying that clueless investors are driving the markets up, and it's kind of funny because I'm waiting for this next correction. But if you look at like the Dow today, it's at like over 27,000, which is like not even 9% below the peak in, was it February or March of 29.5. So it's super interesting how this market is doing so well. And we talked about it multiple times before too, right? Where how we're saying, a lot of it's the feds and the stimulus and all of this. But this is the first time I read that someone's saying, it's like, not to say dumb money, but it's like kind of like dumb money getting thrown into the market, right? And I mentioned this multiple times before too, right? It's like when the taxi driver, your Uber driver starts giving you stock picks, it's like not a good time to be in the stock market. But I'm just trying to figure out when this correction is going. And I'm actually in a short position. I have a lot of funds sitting in money market, and I'm actually in some positions that are trying to short the market that I'm getting beaten up over. So for those people that are wondering, yeah, I do real estate, buy and hold, residential, and I do stocks and bonds too. So
I'm 100% alternative assets, so no stocks, no mutual funds.
Yeah, no crypto though. Any crypto?
No, I don't know. I focus on buy and hold real estate.
Your bread and butter, yeah.
But for most people, I get it. You want to diversify, right?
No, exactly.
Yeah.
And at least if not in what you're putting in, at least geographically, like, right? Because we're doing real estate, so we want to be geographically diversified, or in different industries, residential, commercial, or whatnot, yeah. Or classes, right? A, B, C.
I stay away from things that easy come, easy go, right? Short-term rentals, easy money until it's not, right? And all these guys have to unload their properties. So I'll just take over from here. If you guys want to check out my podcast on passive investing, mostly on the mainland for Cashflow, check it out, SimplePassiveCashflow.com. I'm really proud of my YouTube channel. We went over 1,500 subscribers there. One of my goals of my childhood is become a YouTube star. Kind of half joking there, but yeah, pandemic-proof investing. Things that I'm not investing in are things with elevators, because you can't socially distance there. Dense urban areas, because we're seeing people in New York getting cabin fever, having to stay there all the time. Things without cash flow. So I don't plan on investing for speculation. I'm trying, the backbone is cash flow. Lower end tenants. Seen some of the Class C properties struggle a little bit, and I'm kind of like to work with more people with more than $1,000 in their bank account, so more B and A class. We're seeing through the pandemic retail shopping, short-term rentals, and assisted living get killed in this environment. Also pro-tenant states, and you see all the memorandums on or moratoriums on no evictions. To me, I don't invest in any blue states. I invest where the laws are on my side, the landlord side. Office space, who knows if people are ever going to go back to office. And then San Francisco Bay Area is getting creamed right now. What am I investing in? Well, garden style apartments. Now, garden style apartments are anywhere from 1 to 3 stories, typically without an elevator. But these are kind of like a motel, like how you drive up to your room. Everybody's got their own entrances. There's no hallways. Workforce housing. I think we've shown how robust workforce housing is. B and C class and lower A class. Where middle of America is, not the luxury type. And suburban locations. So a little bit outside the city center, maybe about 20 minutes. That's how you pandemic-proof your investment portfolio. A little bit of a phenomenon that's happened across the nation. Those ages 23 to 30 are moving in with mom and dad. Nothing new to Hawaii, but it is happening a lot more. It went from $300,000 in March up to $1 million in April and May. So definitely a trend to watch. Rent Cafe did this cool study on kind of polling people when they're going to buy, and the takeaway was about a quarter of the people say that they probably will never buy a home. So if you're a landlord and there's more renters for you, and people are all parts of the divide on this. Maybe home ownership isn't for everybody. A little bit of a fun map here. This is the richest person in every state. Don't know what this really does to your investing, but it's just fun to know. You got Mark Zuckerberg at 81 billion, Jeff Bezos in Washington, 117, Ray Dalio at 18 billion, Connecticut. This dude, since we're all from Hawaii here, Pierre Omidara. I don't know who that is, to be honest. Maybe I've heard of the name. Someone's probably laughing at me now, but I don't know who they are. They probably made their money somewhere else and moved back here.
That's eBay, Lane.
Who's that?
It's eBay.
Oh, I love eBay. Well, he probably never made eBay in his basement in Hawaii.
His kids, I believe they go to Punahou now, and so he moved his shop over here.
Cool. Good for him. Hopefully he doesn't invest in real estate, then he doesn't have to pay any taxes. Most and least affordable cities for home ownership. Hawaii's not on here, but just some of the, as you break it up into regions, obviously the southern and southeast are going to be some of the cheaper places to live. So it just kind of highlights some of the bigger ones. But I have a Facebook group that if you guys want to join, this is more my mainland group. Some of the best data comes from, each of us. It's quicker, it's more raw. Who knows what to believe in the news, right, these days, especially all this data that comes out. One individual says, I'm seeing people move out of the San Francisco Bay Area to lower cost areas in California since COVID has enabled them to work remotely. Real estate seems to be picking up in those areas like Sacramento or El Dorado County. And then another person says, rents on average in San Francisco are down 12% from peak highs, as much as 20% in some areas, which this is sort of correlated what I've been seeing with in legit publications. They're saying as much as like 5% rent decreases. Where saving for a down payment is slowest. Yep, you guessed it. Hawaii is up on the top of the list there at a median home price of over $700,000 at a 20% down payment of $145,000. It's going to take you 109 months to save that, or 9.1 years to save for that down payment. It'll probably take you, a dozen years to save for that Core Ridge property. I don't know if they take into account that our wages are way lower here.
Well, for these market priced units that you're just getting you're getting qualified by a regular lender. Yeah. Mm-hmm. So they're just looking at all the good stuff like, DTI and debt service coverage and all that stuff. So they're qualifying you like, it's not subsidized, or, it's not none of that stuff yet.
Some commercial news: senior housing occupancy slips to all-time low. That was one of the big three: assisted living, retail shopping, office space, Airbnb stuff. Short-term rentals getting killed in the pandemic. I've been starting to look at self-storage as an investment. It's nice because things don't have rights like how people do, and the landlord laws. I don't know if you call them landlord laws because it's not people, but very great cash flow type of investment. So I've been kind of looking up more on this. So top 5 secondary markets to look out for self-storage development: Augusta, Georgia; Providence, Knoxville, Rochester, and Rochester, Springfield.
When I had cable, I used to like watching Storage Wars.
Yeah, I used to love that show too. I would download it off the internet. Yeah, but it got repetitive, right?
Yeah, then it seemed like they started like making up stuff just to make it more exciting and not the same old.
Yeah, but it's like treasure hunting. I think that's why some people like to still do deals even though they're retired and accredited. Just the hunt, right?
Exactly.
So not all markets have retracted rents. Places like Huntsville has actually powered through, and rents are increasing through the pandemic. Other places like Jacksonville, I know a lot of people have bought turnkeys in Jacksonville. They're actually seeing a slight decline in rents. So again, this is what we call about knowing your sub-market, not everywhere it's not like a national market. Construction costs decreased for the first time in a decade, and this makes total sense, right? Less demand on contractors. So the contractors, they have less power in terms of pricing.
Deflation.
Marty
Sorry,
Yardi
go ahead, sir.
Matrix comes out with a report, and some of the takeaways here is U.S. rents decreased by $2. The average was $1,457 a month. So it came down slightly, $2, not much, but continued a 4-month trend decline, which makes sense. This tends to happen due to a pandemic, I guess. Average rents declined 0.8% in the first half of 2020 and 0.4% in the second quarter. This is a stark contrast from 2% rent growth in the first half of 2019 and 1.2% growth in the second quarter. And typically, when you guys are underwriting your own deals, most people will say use a 3% rent increase a year. And I think we kind of mentioned that when we were showing the prices of the homes. It was interesting that it should be increasing. I mean, there's inflation that's typically always happening.
Lane, when you underwrite the commercial deals these days, is there a bit of change? What I've been trying to do is getting a little bit better grasp, because for us residential guys, 1 to 4 doors, investor loans are a little bit hard to get, even though the owner occupant rates have dropped, below 3%. It's a little bit more challenging for us investors on the res side anyway to get deals nearly as good. So I'm just curious how it looks on the commercial side for you guys.
Yeah, I mean, normally they say like underwriting 101, use like 2 to 3% rent increase just to keep up with the pace of inflation to account for it. And just very similar to like if anyone's in, you're a project manager. When I was a construction project manager, you're trying to account for projects in the year 2025 or 2030, you use usually a 2 or 3% multiplier, right, to account for inflation based on what your economics department says, right? A lot of that kind of just flows down.
And how about assumptions for your debt? Is there any changes for that?
Yeah, I mean, dude, like we're seeing like 2.9% interest rate on some of these commercial loans. I mean, it almost makes sense just to like, even if it is a lukewarm property, just to load up on this great debt. I mean, so many people have it the wrong way. People are like scared. How could you be scared when you're going into 2.9% and you're cash flowing? Makes no sense to me.
And one thing, Lane, that I was reminded to that we should be sensitive to listeners too, because some people are we're going through challenging times. We have furloughs and layoffs, so I know we have listeners who may be in that situation or coming in that situation. So I think to your point too is like you wanna we're trying to pivot, and I think that last slide that I got cut off because of my having audio difficulties is they say a crisis is a bad thing to waste, and it's for the people who are in a good situation and that they can do these kind of things. That's great, but I mean this lesson is to, if you're you're getting not to say the short end of the stick, but if you're in a bad situation, then try to pivot. Of course, it's easier said than done, but try to pivot and look at maybe looking for the next career that's more, not to say job secure, but because like I said, this COVID thing, no one knew was going to happen, right? But try to pivot and make sure your finances are even more secure. So just wanted to bring that topic up.
Yeah, and the whole COVID, like it's really unfortunate how it life is unfair. It's infected some people, and then other people are just unimpacted at all, right? I mean, you can't really say that, like before, like some of my dentist clients, like they're just out of work, and they were. I mean, to me, if I were to bet on a profession that you're always going to have work, it would be that. But like and who would have predicted, right? I mean,
Yeah.
to me, the takeaway is if you have a job, there's no way you can pandemic proof your job. I mean, who knows, right? What's going to be next, right? Who knows what else comes out of the hopper? That I think at the end of the day, it's multiple streams of income. That's the only way you're going to protect yourself and diversify. Like, life has risks. There's an if in life.
Yep. Good. Well put.
And it's unfortunate, right? Like, like all these businesses are closed, and for no reason, like, it's just unfair that right now the fat is kind of being trimmed, and unfortunately it's not the small businesses that are going to be able to survive. It's all like the mainland big boxes that are well capitalized that can push through it. To me, that's, if there's someone I feel bad for, it's the small operator. But this is the opportunity that I think this is a Rockefeller probe, right? When there's blood in the streets, and there's, in a way, it's blood in the streets right now. This is where people who are capitalized can go in, and this is where you create a legacy for yourself.
Yep. Very good.
Yeah, I mean, you and I are kind of lucky, right? I mean, kind of lucky stars all the time.
I mean, I'm still having to pivot too from the standpoint of the real estate sales side, I guess, because we definitely seen a drop in terms of the people who come through to open houses. So, and a lot of times I like to meet up for lunch or coffee to meet with prospective clients. So, like, it's a pivot for me too, right? Trying to reinvent, or you can't just do the same thing over and over, because it's we see the environment changing before us. So, if we want to survive, we need to change too. So that's it's sad in some sense, but it's motivating in others. From the standpoint, okay, we got to look for what's going to be the new normal, what's going to get me ahead of the game. So it's kind of fun from that standpoint. So you got to have positivity. I mean, it's hard to do. I know a lot of people are, like we said, are suffering too, but trying to be positive and put a positive twist on things as we talk. And that's all we can do, right?
Yeah, man. I mean, that's the right attitude to have, right? Things don't happen to you, they happen for you, even bad things. I mean, I've talked to so many people these last few months, like, they're like, oh, I just lost my job. But then I started to listen to your podcast, and I finally realized that all the stuff I was doing was completely wrong, right? And now I'm super motivated, right? Or
that is so awesome, dude.
I mean, like, maybe we're doing some like Airbnb stuff and not investing for cash flow. You're just kind of betting on appreciation. Well, should be a wake-up call.
Right.
A third of your stock portfolio goes away. Easy come, easy go, right? If you didn't work for it, you just bought low, sell high as your strategy. I often say, was it a good strategy? I mean, maybe just me. I just don't think something is reliable unless I'm putting a lot of effort into it, hard work.
Had a couple friends that got laid off or actually ended up quitting, and just it's part of it's because they have young children. But I reiterated with them too, is because like they like me have young children, so I always like to tell those people on the same boat. It's like, well, our kids are young, and it's still cool to hang out with daddy. So I'm taking advantage of, these days at home with them as much as I can. So, like, to my friend that got let go, they're doing a lot of fun stuff. And I those kind of discussions with people help remind me, of the choices that we've made and taking advantage of that. So I took my daughter to the pool, did some GoPro recording and underwater, and turned it into a video and all this good stuff to capture it. And, it's not gonna be cool to hang around with that in the next 5 years. So I'm trying to.
Yeah, you're gonna be not cool to hang out with, and you'll hang out with me.
Yeah. Over at the club, right?
At the club, yeah.
Not the disco club, but the social club.
Yeah, social club. Yeah. So, and just another example, right? A lot of people were gambling on appreciating properties in the Bay Area, some of the hottest area of the market. And now look what happens. Yardi is reporting rents are down 4.6% in San Jose and 3.8% in San Francisco. I mean, easy come, easy go. I mean, there's cyclical markets out there. A lot less deal flow. I mean, everything has kind of slowed down. Freddie Mac reports a decline in 20 to 41% of origination loans in 2020, which makes sense. Everything is kind of just slowed down. Here's a little shot of the mortgage rates. I mean, if you got money, I mean, geez, lock it up. 2.9% is unreal. I mean, it's not much. Who cares if it goes lower than a quarter point? It's like pretty much all-time lows right now.
Free money.
Free money.
Yep.
Exactly.
But
and
leverage smart, right? Leverage smart though, right?
Right. Leverage enough so that you comfortably cash flow, of course.
Yeah.
Right. Let's not be irresponsible about it.
It's like, yeah, to your point, if you're banking on appreciation versus, the cash flow, then that's the hard part. Well, live and die by the sword, right?
But it's, I mean, all signs point to inflation going up. I mean, how else are we going to pay for that? What, $3, $4, $5 trillion of stimulus going in right now?
That's going to be very interesting, which, I mean, it's a good point about real estate, right? They're talking about the short-term deflation, but then long-term inflation and or, increase in taxes to pay for all of our debt, right? And what we talk about, the great potential tax benefits of real estate, right?
Right. So you were talking earlier about your local economists. I got another economist that I kind of follow, Richard Duncan. He's
cool.
His theory is like we're always kind of going into debt, and I mean, I think most people have a adverse understanding of debt. But if you keep printing money and you're the most powerful country in the world and you control the money, the dollar, you can keep doing that, and that's what America is doing.
Right.
I don't like economists. I mean, I follow this guy, but I don't like economists at all because they're like weathermen. They just make these predictions, and I've talked to a couple of them in person that are supposedly like well known, and they don't own real estate. Like they don't have skin in the game is my problem, right? They talk about this big macroeconomic stuff, but they're not boots on the ground buying a rental property or in a market. They don't have skin in the game. They don't have money in the market, right? They're independently wealthy, and they're just taking lob shots at what's going to happen, and they kind of just explain what happened with some arbitrary quote. Sometimes that's what I see. Like, here's a guy, Sam Zell. He's kind of well known, but he's quite the opposite of an economist. He's actually a guy going out and doing this stuff. He's pretty much like a Warren Buffett, just a lot less well known. But he's the guy. He went into mobile home parks a couple of years back. And this guy is pretty, I mean, just Google him. I mean, he's got a huge track record of going into the right stuff at the right time. So he's calling sort of like a U-shaped recovery, recovering after the year. Yeah. So I'm pretty bullish over this whole situation. I don't know about how you are. What's your crystal ball saying?
Like I said, I'm lock loaded and ready and trying to get more funds ready to pull the trigger, right? Get the dry powder ready. On the stock side, I'm waiting, and then on the real estate side, I'm trying to get the deal flow to see what's coming. I mean, it'll probably be a little while. Because real estate, there is definitely a lag, for the rest compared to the rest of the economy. So, people waiting for the short sales and the foreclosures are gonna probably have to wait, especially the foreclosure. I think the court systems are shutting down again, and even when they tried to reopen partially, there was, at least locally anyway, my understanding was the judges were very practical from that standpoint and having leeway for the defendants.
So we're kind of getting up to the end here. If you guys want to submit your questions, type it into the question answer box. Can you grab those, Dean, in there? But before we do, the last little free giveaway that we usually have for those who stay all the way to the end is a little packet of some tutorials on how to do this mortgage rate arbitrage tactic, where you use your HELOC, which is simple interest, to pay off your amortized interest. Yes, it does work, but I'm not a big fan of it. I'd rather see people invest. But hey, if your goal is to be debt free, more power to you. I mean, to me, being debt free is not correlated with financial freedom. Most people who do this, they pay off the mortgage and they're like, all right, well, I paid off my mortgage. I'm still feel poor. Just your house rich, but cash poor. The way you're going to build financial freedom to be able to quit your job is with cash flow and buying assets that put money into your pocket. So if you guys want access to this, shoot me an email at Lane@SimplePassiveCashflow. But yeah, Dean, what are some questions?
So one of them was about the first Easter egg you had at the beginning, that giveaway, how they can get that.
Shoot me an email at Lane@SimplePassiveCashflow. I'll drop the link to you guys.
And there's another inquiry about self-storage and monthly cash flow. They want to get more information or want to know about how that works.
Self-storage, very simple, right? Like someone pays you rent to store their stuff. Supposedly it's on the recession-proof side, because say the economy goes to crap and like people get foreclosed on, the theory is that they're going to need a place to store their stuff as they downsize all their cool stuff. And the nice thing about self-storage is people are usually intolerant to huge swings in their rents. Like if I change Dean's mortgage payment, that's a lot of money. Like even if I change it by 5%, but if I change your locker size on your self-storage by 10-28%, you'd be like, who cares? It's $20, whatever. It's kind of like the what is it, Planet Fitness model, right? They're like, oh, we'll just like make it really cheap so people forget about it, and because eventually people don't go to the gym after the first couple of months, they just give up. But maybe it'll be so low they'll forget about it and they'll just keep paying us.
And one of our tried and true listeners, he said he wants in on the next self-storage deal because he's interested in monthly cash flow, is what he said. So thanks, Mark.
Yeah, you don't feel bad about evicting him.
Yeah. So put Mark on your tickler. He said he wants information on the next deal that you do.
Right, well, if you want to join the deal club, SimplePassiveCashflow.com/club. We got to build a relationship. Not all deals go well, but that's why we invest off relationships, right?
That's all we have for questions.
All right. Well, we'll see you guys next time. Here's the legal notice and disclaimer. We are just a couple guys giving some info, not legal or financial advice here. We'll see you guys next time. Bye.
See ya.
Free real estate investing group. Check out reialoha.com.
We're just two local guys with so much to say. So listen to the Real Estate Braddahs today.